play hard, we work hard, play hard, keep partying like it's your job. Work hard, play hard, work hard, play hard, we work hard, play hard, keep partying like it's your job. Come on, baby, and drop it. Scrub the floor and just pop it. Show these gangsters how you pop pockets. Don't care what you got in your pocket. I pick the way that you rock it. Flip that bang, bang. Girl, stop it. Wanna just bang, bang, and pop it. While the club crowd are just watching you work it out. Got a gang of cash and it's going all on the ball. And it's going fast cause I feel like a superstar. Nobody here knocking at my door. The sound of silence, I can't take it anymore. Nobody ringing my telephone now. Oh, how I miss such a beautiful sound. And I don't even know how I survive. I won't make it to the show without your love. No, I don't even know if I'm alive. Oh, without you now, this is what it feels like. Nothing to hold but the memories and frames. Oh, they remind me of the battle I faced. Without your love, without you I drown. Somebody save me, I'm going down. And I don't even know. All right, guys, we're going to go ahead and get started. Want to welcome you to our HFX Trader Training on Mastering the Skill. This is your host, Brandon Boyd. Super excited to have you guys here on this great Wednesday. I want to say good afternoon, good evening, even good morning to people around the globe. We are excited to train 5 days a week. The call is being recorded. We want to welcome all the new team members, everyone that has joined in the last 7 days. We want to welcome you guys here. Put new, N-E-W, if you're brand new in the last 7 days. We are grateful to have you here. Also, put where you guys are calling in from. We want to see who we have around the globe that jump on these calls each and every day, hoping to bring you guys the value that you guys are looking for. So just as a quick reminder, we do have the weekly results that we want to do. So as soon as you hit a minimum of 50 trades, so a series of 50 with a win rate above 70%, we want to recognize you guys. So we don't care if it takes a day or a week or whatever. Send the results to jbboyd25@gmail.com. Again, that's jbboyd25@gmail.com. And so we need a clear photo of yourself, the win rate, wins versus losses, and the proof. Okay, so a series of 50 trades, win rate over 70%. And then we're going to recognize the top 3 traders as well. Out of all the people that send information for the flyers, each and every week, we want to recognize the top 3 as well. So you not only get on a flyer, but you have that chance to be on the top 3 recognized on social media. So a couple things I want to show you guys real quick before we jump into this session. I'm going to take myself off the camera here, and I'm going to do a share screen. And by the way, if at any time you can't see my screen, just let me know. One of the services that we use is called Hourglass. For those who are brand new, it has the cash trap strategy inside of it. And this is a strategy that we teach on a lot, as well as Matt Thayer. Matt actually created the scanner for this with the programming team. They are releasing, it's supposed to be this week, the 2.0 version, which is even more accurate, makes it easier to read the market ideas, even says call or put underneath or on top of the arrows. So you will like this. even more. So be waiting for that 2.0 release. And what we're going to do with that as well is we will make an updated Cash Trap Mastery guide for you as well. So you have a new guide. You're going to have a new video training on it, and it's going to make things even better for you, which is going to help increase your win rate as well. Okay. Now, it's a part of it. So, by the way, if you want that, $22 a month. It is not part of the HFX membership. Go to your back office, click on menu and shopping cart, add it, 75 cents a day, $22 a month. And again, it's called Hourglass. It's optional. It's not something you have to have, but it is highly recommended. Now, as part of our service, we get you guys on Go Live like you're seeing here. You got the top featured sessions right on the cover. You have the channels here. So we're on HFX. The HFX channel is going to give you all the high frequency Forex educators with their schedule when they're actually doing their trainings. Okay, so we're on here 5 days a week. We teach on mastering the skill 1 p.m. Eastern every day, except on Friday we're at 12 p.m. Eastern Standard Time so that we don't get in the way of the Matt Thayer session as well. So you click on this here. It's going to bring you to the TV where we're doing our live session. And underneath, you're going to see all the recordings that we do. Everything that we do is labeled as well. So any title that you want to go back to some previous sessions, you can do that. I want to point you, though, to the favorite sessions. The favorite sessions that we have answer a lot of the questions that come in, such as how do I use TradingView? When do I get in a trade? You know, exactly when I enter. What are the settings of your Bollinger Bands? How does the web slinger work? What about Cash Trap? How does Pickpocket work? And even some of the basics of how binary options trading actually works. We have that inside here as well. So make sure that you guys are tuning in to the favorites tab on ours. Share it with other people. We put out these recordings on Telegram and Facebook so that you guys can log back into Go Live and look at them at any time. But make sure that you guys are doing that. Last thing I want to show you before we bring on Dr. Lee is during the month of December, the HFX team is doing a giveaway, $30,000 giveaway in December. The way this is going to work, and I'll make it very simple, is the top 5 enrollers of an HFX package are each going to receive $3,000. That is in the month of December. Okay. Now, they're going to do a raffle for 5 active HFX customers. So my recommendation to you would be to remain active because each of them are going to get $3,000. So $30,000 will be given away in the month of December. More details will come. So there's the flyer. We have some promo videos out there on Facebook, Telegram, some of the stories and stuff like that. Make sure that you guys, oh, and by the way, a caveat that I was asked about is, does the Elite package count? The answer is no. It's just HFX packages. Okay, top 5 enrollers. So some of you watching this right now, you may be one of those individuals that's going to win $3,000 in this month. So what I want to do now is a stop share, and I'll bring myself back up on the camera here. I want to introduce you to my trading partner and educator, Dr. Josh Lee. We met 18 years ago in college. He went off to become a doctor. I continued off and did networking. And then we came back together when I introduced trading to Josh. He got right into it, absolutely loved it. And long story short, he no longer is a practicing doctor. Still has the label, still has the title, but this is what he does. He's doing this now for the lifestyle, the time freedom, and also the passion too, is following something that you're passionate about, but also what you're good at the same time. Josh wanted to be able to spend more time with his wife and kids. He has 6 kids. I've got 6 kids. So think about it. Between Josh and I, we got 12 kids. I mean, that's a lot of kids. And so nobody has excuse of I'm busy, I don't have time. He was working 40, 60 hours a week, still having to balance a family and trade and all that kind of stuff. So just know that no matter how much you are limited on time, it is not time, it is lack of direction if you are not where you want to be with your goals. So with that, we'll go ahead and turn it over to Dr. Lee, put some fire emojis inside the box for Dr. Lee.
Excellent. Thank you so much, Brandon. Great to be with you all today. Today is Wednesday, and we're kind of midway through our week as we continue to talk about all of the key important concepts that you need to understand in order to become a master trader. What does it mean to be a master trader? It means that you have mastered the skill, that you've really taken the time to learn a lot of those key fundamentals that contribute to the whole of your knowledge in trading. But then it's not just that, it's that you take that knowledge, you begin to apply it, you practice it over and over again to where you become independent, you become capable of identifying those trade opportunities yourself without even relying on a lot of the Go Live educators. Now, we have all of the resources that you need in order to do that. Part of it is the education, the details. That's really what Brandon and I focus on with our education, is getting into the meat, getting into the minutia details to make sure that you understand what you're seeing. Most people, when they first look at a candlestick chart, their first question is, well, what in the heck is a candlestick, right? What's a pip? What are these Forex pairs? What's a pair even mean? A pair of what? You know, are we talking about pairs of shoes or pair of socks? No, it's like there's a lot of little new terminology and details that we need to understand in order to learn and master this skill. But in addition to that, you need to practice. And that's where a lot of the other Go Live educators come in very, very handy. So when you get on with Millie or DL or Matt or Ness or Evan or any of the Go Live educators who are calling out live trade opportunities, really that's an opportunity not just to make money, even though that's exciting and that's fun and great and so forth. Ultimately, those are an opportunity for you to be able to practice alongside with somebody else who knows what they're doing. Just as if you were learning to drive that car, you typically don't go drive it by yourself. You have an instructor sitting in the passenger seat who's going along with you, who can provide some feedback and guidance along that way. So gain the knowledge, practice with the Go Live educators, continue to practice on your own. And as you do so, make sure that you're not risking a lot of your money. Right? If you happen, I mean, we recommend initially starting with a demo account, trading with, which is essentially fictitious money, but in real live market conditions. That way you get a feel for how it works, and you have the ability to practice when there's really nothing inherently on the line. Ultimately, you do go to a live account, and as you do so, you gain that experience. Now you're introducing some emotion into your trading because you have fear of loss. Oh my gosh, I'm putting real dollars on the line. If I lose this, I really lose that money. And so there's something a little bit more inherent that comes on the line when you do that. But that's an important part of the progression of your growth and knowledge and experience. And ultimately, the goal of all of this is, as you gain that knowledge, as you gain the experience through practice, you'll ultimately develop the wisdom that makes a master trader. Somebody who can look at the charts and say, I can see the structure, I can see the trend, this is where I want to get in, here's my trade entry reason, and boom, you get in the trade, and it's just like plug and play, and you do it over and over again. Another big important part of that we talked about yesterday is the ability to take a loss, right? That's an important part of our overall trade experience. Because it does happen. It will happen. We can guarantee that on occasion you're going to have losses, right? And if you trade a lot every day, you're going to experience loss every single day. So get used to it. It's part of the overall equation. And that brings us to our first point, which is mindset. We talk every day about mindset because it's our mind that ultimately leads us to that long-term success with our trading. It's not trade strategy alone. And the thought I want to share with you is this, and it's by Babe Ruth. He says, never let the fear of striking out keep you from playing the game. This is huge when it comes to trading. I admit that I have dealt with this fear myself. When I've got involved with trading, it's my personality, my fear type. We've talked about fear types in the past. Most people are either fear of loss or fear of missing out. When you have fear of loss, you really have this inherent fear that you're going to strike out. You're either going to blow your account or you'll lose too many trades or whatnot, and you're going to lose your money. And so rather than face that potential, even if it never happens, instead, a lot of people quit. And they say, you know what, because there is the possibility that I could strike out, I just won't play the game at all. That's how they stay, quote, safe, right? And so we need to remember for each of us that regardless of your fear type, never let that fear of striking out keep you from playing the game. We teach you within this program how to manage risk, so that this never even has to happen. You literally, I mean, if you're risking 1% per trade, that means you have to lose 100 trades in a row in order to blow your account. So the only reason, if you ever meet somebody who says, oh, I blew my account doing that, the only reason why that happens, and I'd bet $1 million on this, that they over leveraged their account. It wasn't because they lost 100 trades in a row. It's because they over leveraged their account. They began to risk too much. And if you risk too much, yeah, you're certainly going to strike out, right? And so make sure and only risk a proper amount, but don't let fear control you. And to add to that, the secondary thought is that fear does exist in the heart of everyone. Every single one of us, without exception, from the chairman 750s to I guarantee you Chris Terry himself, all of the executives, all the way down to the brand new person who just joined the business, everyone deals with fear. They have fear of loss, fear of missing out, fear of failure, fear of not being enough. The presence of fear, you see, is not what defines us. It is in how we respond to fear that determines our destiny. So what is the answer? We have to own our fear. We have to recognize it, acknowledge it, speak it out into the open so that it's no longer keeping you in the dark, keeping you down, and keeping you bound by inaction, or with inaction, because you're afraid to act. You're afraid that if I am seen as a failure, that's just too much for me, so I just won't try. I'm afraid of loss, thus I just won't even execute a trade. I have fear of other things, and so you just don't end up executing or taking action on things. So own your fear. Don't let fear own you. None of us will eliminate fear completely from our lives. That's an important principle. Okay, but it is not the presence of fear that defines us. It is in how we respond to the fear that ultimately determines our destiny. So own your fear, don't let fear own you. And now let's get into talking about the markets. Today, on Wednesday, we're going to be talking a lot about technical indicators. Technical indicators are simply mathematical tools that calculate information or data based upon price movement. So when we're looking at a chart and we see all of these candles moving up and down and up and down, ultimately, all of this price data can be calculated. We can determine, well, what's the average of price movement? What's the top, the maximum or the high points of price movement? What are the low points of price movement? And so we can, based upon different points of data, there are technical indicators that take those points and they create calculations and then plot a line, typically on the chart, that gives us a graphical illustration of that data. Okay, and to illustrate this, I want to show you this. Let's get down to this one right here. Okay, the moving average line. At the heart or the foundation of all technical indicators, the easiest way to understand how technical indicators work and how they help us in our trading is to understand kind of how they work. And to begin, a moving average is a great place to start. So on this particular chart here, we have this blue line that is underneath the price. Now, why is it underneath the price? And how is this line plotted on our chart? Well, this is based on what's called a exponential moving average line. There's different kind of moving average lines. They all basically function in a similar way. And ultimately, they're all based on a certain length. The length refers to the number of candles. These are the points of data that it's going to base its calculation on. And because it can only calculate an average of 1 point per candle, typically you'll see a word next to the length. So here this says EMA, that's exponential moving average. The number 20 refers to the length. So this particular blue line is based upon 20 candles worth of calculations. And what point of data is it based upon? Close. So this word close, when you see that on any indicator, what that means is that it is basing its calculation on the closing price of the candle. So for example, this tall green candle here, the point of data that it's utilizing in its calculation is the very top, or the closing price number of that candle. It's not the entire candle, it's basing it on just the closing price. That's what the close means. So in your settings, you could actually change that. You can say, I want this to be based on the low, okay, or the bottom of that green candle. Now, most people, they don't change this all that much, and you don't really need to. But I think it's important that you understand at a very basic level how these indicators are formed and why they become useful. Now, because they are calculating an average point of multiple candles, they are both helpful as well as limited in their nature. They're helpful because they do kind of give us an average, right? As price sits above a moving average line, price is said to be moving in the upward direction. When price is below a moving average line, price is said to be moving in the downward direction. So this can become very useful to identify general trend direction, especially when you're brand new and you see that the price is moving up and down constantly. You need some kind of visual reference to say, I don't know if price is going up or down. I don't know if I'm in a trend or not. And so by adding even something as simple as a moving average line can be very useful at identifying trend direction. Again, we make our money in HFX specifically by identifying price direction, making a price direction prediction by a certain time deadline. So first, understanding which direction price is going at is obviously very useful. So that indicator, does it tell you exactly when to get in the trade? Not necessarily. We can come up with rules and strategies to combine it into a strategy, but the indicator itself does not inherently tell us when to get in. For example, as price really surges up and you see all of these green candles in a row in this area here, we could assume, hey, we're in a strong uptrend. But if we start placing call options during all of these red candles, as this retraces back down towards the moving average line, we could be sitting in drawdown that entire time, or be sitting kind of in the negative or out of the money in HFX terms. And so during that time, we could be rolling over those trades. We don't know if price is coming back. So the location of entry is important. And so we want to consider our timing of entry. We've used the analogy before to where the location where we get in a trade, even in a known uptrend or a known downtrend, is like getting on the specific bus stop that gets us going in the direction we're going. We may know that the bus is headed north, but if we don't know where the bus station's at, the bus stop, so that we can go get on the bus, then we're going to miss it altogether, right? We could even be correct, but if we just run out in the road, say, hey, here comes the bus, it's going to run you over. And that's where losses occur if we get in at the wrong time. And so similarly with our trading, we need to know when to get in the trade. And we'll talk about that as the week progresses. But for today, with these technical indicators, again, this is giving us a general idea for trend direction. And you can see on this simple example how when price is on one side or the other, either above or below, that can be an early indication of trend direction. But does it always work? If the market always moved in very nice, strong, progressive trends, then yes, something as simple as a moving average line could be total moneymaker, right? And it would make the trading extremely easy. And at a level, it kind of is that way. But there are times when indicators work really well, and there are other times where indicators don't work really well if we make the decision that we're only going to read them in one way. And so today I'm going to teach you the correct way to read it in both circumstances. To understand that, you have to understand this initial principle of market phases. We've talked about this in the past. We haven't reviewed it in a while, so I want to review it now. There are three basic phases to any wave type or any phase of the market. The first we refer to as consolidation. This is where price is generally moving kind of sideways in a lateral channel, almost like it's in the middle of a pipe. And there's a relative top and bottom to all of the pivot points, or points at which price turns around. And then price moves into an expansion phase. This is a useful phase for market makers and large institutions, because in the open Forex markets, or even within stocks or any kind of financial instrument, they need liquidity. If you want to place $100 order or a $1,000 order or even a $100,000 order, relatively speaking, in the overall liquidity of the market, that's a pretty small order, right? So it doesn't require a lot of liquidity in order to fill your order. But for the large banks and institutions, they're placing orders in the hundreds of millions of dollars. And so they need liquidity. They need somebody else on the other side of that trade. Right? And so in order to take advantage of that liquidity, they know that people have pending orders above and below these zones of consolidation. And so price generally pushes above, and it doesn't necessarily do it in this order, but price generally pushes above that consolidation phase as well as below. That takes out a lot of those pending orders that exist above and below the phase before the market then moves into the trending phase, which is consistent progressive move in one direction. Even though, yes, the market is always moving in phases, and there's a primary push and then a retracement, a push and then a retracement, right? Some people call those a pullback. Those pullbacks are normal part of market wave behavior, but we can note that with a breakout and retest that we've talked about over the last 2 days, we can begin to see and identify these consistent trending times in the market by identifying first the pivot points and then looking for a breakout from those previous pivot points in the market. So now that you understand the basics of these different phases, most of the time when we are trading, when you and I are trading in the market and we're looking for trade opportunities, we're looking for either zones of consolidation or trending times. Why not expansion? Typically because expansion phases are very short-lived. These are not consistent times where there are predictable trade entry reasons that we can take, and typically they only last for a number of candles, and so you mostly don't have to worry about them. Occasionally we'll take a loss during an expansion phase, but that's okay. Again, losses are part of our overall trade plan, and so we just take them as they come. But most of the time we're looking for these consistent trending times or phases of consolidation. So let's jump to the live chart and show you in a little bit more detail what this looks like. Now today I decided to jump to a different pair. Typically I sit on gold because Brandon and I trade gold a lot, but I really want to emphasize that it doesn't matter what you trade. It doesn't matter what currency pair, what commodity index, cryptocurrency, it does not matter. So today we're going to be using the British pound to Japanese yen. You can see that here in our upper left-hand corner of our screen. We're on a 1-minute time frame chart. Part of the reason why I use a 1-minute time frame chart is because HFX, we do very short-term trades, and this shows me enough detail to be able to analyze the wave structure of the market. I often will also use the 5-minute time frame chart, and we can see equally a lot of potential trade opportunities on this time frame. But whenever we're using Hourglass or Go Liberty, which typically show the price on the 5-minute time frame, on my own TradingView account, I typically am looking at the 1 minute. That way I can compare both the 5-minute as well as 1-minute data and make my decisions based upon that. So for today, as we look at the British pound to Japanese yen, I chose this pair in part because generally speaking, the yen pairs and the pound pairs, they're considered to be highly volatile, kind of erratic, a little bit of like the unruly child, right, of the Forex markets. But I want to show you and illustrate to you today that even amidst some of the more volatile pairs out in the marketplace, there is an abundance of predictable structure that we can base our trades upon and make consistent money. All right, so with this, what we're going to start out by doing is adding a simple moving average line to our chart. And so you come up to the FX icon and you can type in moving average, okay, and it will give you several different types. You can see that there's the moving average exponential. This is starred simply because I started just to kind of save it to one of my favorites. That's what a star means if you happen to have a TradingView account. There's weighted, there's smooth. There are different kinds of moving averages. Most of the time, you just either need a basic moving average or an exponential, which is probably one of the most common types. So we'll go ahead and add an exponential moving average to our chart. And right now, if we come up to the left-hand corner of our screen, we can see EMA 20, which is the length. That means our line is based on a calculation of 20 candles, right? And then it says close because the calculation is based on a close price. Now, if you want to edit the settings in any moving average line, you have two ways to do that. You can either double click on the line itself, and that'll bring up the options there, or you can come up to the title of that specific indicator, click on this gear icon for the settings. Either way, it will bring up your same window here to edit the settings. So for basic moving average lines, you'll have two different tabs. One is the input, which gives our length, our source, which is the opening, closing, high or low of the price. And so each of these options will give us a different point of data. For example, if we change this to the high of each of those candles, you'll note that the relative line position changed. If we did the open, it will change again, and it will give us an average of the opening prices. And so more often than not, the close price is what most people use, and it works just as well as anything else. Now on the length, when you're in Hourglass, so if you log into Cash Trap, or if you are in Go Liberty and you're utilizing anything like the Simple Scalper or any of the other strategies that are available within, you'll note that there's this purple line, which is a 200-point or length moving average line. You see it there. You also see it here in Cash Trap. Now, why do people use a 200-point moving average line? Well, as you can see on our current 20-point moving average line, the price kind of pushes into the line repeatedly as it progresses along. And even though, yes, it is a general good indication of trend direction, you see that price kind of pushes into it, which may give a little bit of a false sense or a sign of price. You know, it might give you the impression that price is changing direction when it's really not. And so a 200-point moving average line, if we add a 0 to this, click off of it, it's going to change that. And so it gives us a little bit more of a general idea of which direction price is at. So if we click off of this and we really zoom out on our chart, you'll note here, here on the pound yen, price finally broke way down. You see this large drop in price. And ever since that time, price has just consistently stayed underneath. When price finally broke through, now it looks like we're in a more of a consistent uptrend during this phase here. So by simply utilizing this 200-point moving average line, we can have a basic idea for where the primary force is. Is price moving in the downward direction? Is it moving in the upward direction? This doesn't give us a very solid, specific trade entry reason or the timing of our trade, but it does give you an idea for general trend direction, which is a very important starting point for your overall trade analysis. But in addition to that, we do need a little bit more detail in order to identify our specific trade entry reasons, right? And so we'll leave this one here. In fact, we'll change this color to purple, which you can do in style. You can come over to the color, and you can change this to really any color you want. We'll do a similar color to what you see there in Cash Trap as well as Go Liberty, just for kind of a similar reference. So here we have our 200-point moving average line, and I'm actually going to add a second moving average line to our chart. This one, you can see our new one that we just added is also a 20-point moving average line based on closed price, and we can have this be any color that you want. I'm going to change this one to red just for today's purposes. So when we have these two moving average lines, you can tell that both have their strengths and weaknesses, and we can tell that because one is this purple line certainly does tell us the general trend direction, but it doesn't give us specific enough detail in order to really know when to look to get into a trade. And so when we compare it with this 20-point moving average line, which is the same line that you'll see on the Bollinger Band. So if you're in Cash Trap or you're on Simple Scalper, this middle line of the Bollinger Band is a 20-point moving average line. And so as price comes back close to that, you can expect, if you're in an uptrend, for price to continue in what direction? The upward direction. Because during this time, as price is on top of our 200-point moving average line, it's also on top of our 20-point moving average line, we can see that price is pretty consistently continuing to move overall in the upward direction. The times where we would shy away from maybe call options is when we see that price is now pushing below the 20-point moving average line. Now, right in this circled area, price is below the 20-point, but it's above the 200-point. So the next question is, well, which way are we favoring them? And the answer is that because price is moving in waves on all different time frames, we're on the 1-minute time frame chart. On the 1 hour, it's going to look slightly different. This could very well be above the 20-point moving average line on a 1 hour chart. And so as price comes back down, we could look for price to come close to and or near the 200-point moving average line, and or finally kind of break back above in a breakout retest structure before we predict that price is then going to go in the upward direction, okay? And so again, the 200-point is just general trend direction. It's not giving you the exact entry point. There are plenty of opportunities here where you could place call options and you would lose if you were basing it solely on a 200-point moving average line. So we need a little bit more detail. So having a shorter length gives you more detail. Longer length, such as 200-point, that means it's calculating this line, this purple line, on 200 candles, or 200 minutes, you could say, because we're on a 1-minute time frame chart. And so we still have to look at overall price structure and look for those more detailed confirmations of where price is going to go next. So, but at a very basic level, again, adding the moving average line to our chart is part of an overall visual picture, and we're trying to look at information that maybe price alone doesn't tell us, especially in the beginning as you're a new trader, because looking at price action alone, looking at for breakout retest structure, maybe you struggle to see where that occurs, right? And so a technical indicator such as the moving average line or the Ichimoku cloud or any of the other technical indicators out there can give you additional information as to where price might be moving next or where the general trend direction is. Now, price alone is the earliest indication of what price is currently doing. For example, if we look here I'm going to draw a couple of lines here. Price breaks to the upside of this previous pivot point. We have another breakout to the upside above this previous pivot point. So this is our breakout retest structure. Now, this is currently below our 200-point moving average line, and we don't make our prediction just automatically based on a technical indicator. Why is that? Because generally speaking, the technical indicator is an interpretation of price. It is not inherently telling price where to go next. So it's telling us an average of price movement, but it is not dictating what price will do next, right? It is an interpretation of the price. In other words, price moves, and then the indicator does the calculation. And that's why technical indicators, generally speaking, are referred to as lagging indicators. It's because the price has to move first before the indicator can perform its calculation. So there is a sense of a lag. And so as price continues to break out to the upside and price works into this new uptrend, you can see this beautiful just breakout retest structure as price continues to move in the upward direction, which you can see that our earliest indication that price began to move in a new uptrend was actually way down here, okay? And even conservatively, you could say at this level here, when price really broke out to the upside. That was our earliest indication that we were moving from a primarily downtrend situation here to an uptrend situation. But you can see that the 200-point moving average line really didn't show us that we were in an uptrend until price was in this area, where price was above the 200-point moving average line. So the point being is that every technical indicator has a level of lagging in its nature. The shorter the time frame, the shorter the lag, right? It's not that it takes a long time to make the calculation, but it's just the crossover points may lag in time. For example, if we based a trade on a crossover of the 200-point as well as this 20-point moving average line, where would our entry be? If we get rid of some of these drawings, our overall crossover is right here, right? So at that point, you can see that there's all this upward movement activity that occurred before we finally got this crossover of the two moving average lines. This is true for any kind of momentum oscillator, the MACD. In fact, I'll show you the MACD right now because it's based on the same principle. Shorter length moving average lines, but we're still looking at crossovers. To illustrate that, let's go to, no, that's divergence. Let's see. Here's our breakout or retest. I think it's down here. Here we are. Okay, so for the MACD is a technical indicator that utilizes two moving average lines, a 12 and a 26, and then these histogram bars, which kind of reflect volume and momentum. And basically, whenever these two lines cross, and I've indicated by these arrows, whenever these two lines cross, the trend direction is said to be changed, right? And so I've corresponded these arrows both at the MACD crossover point as well as where it occurred up in price. And you can see that part of the downward movement has to occur in order for you to get the crossover in the downward direction. And similarly for the upward direction, part of that upward move has to occur before you finally get the crossover of the two MACD lines. That's the lag that we're referring to. And so this can be, this is very important during times of consolidation. To illustrate this, I'm going to add this to our chart. So let's get rid of our two basic moving average lines here. So we can delete these by clicking on the X. And now let's add, if we go to our FX, we're going to add the MACD to our chart. So here we have a MACD with just standard settings of 12, 26, and 9. The same principles and rules would apply to stochastics indicator, even an RSI, if you're not reading it properly. But ultimately, stochastics and MACD are both pretty similar in this regard. All right, and that is that during times of consolidation, on the British pound, we kind of overall had an upward move, but you can see here that price has generally gone pretty flat, right? And so as we begin to look at the crossovers that the MACD is giving us, some of them you could say are false signals. So here we have a crossover. Let's just go through a few of these. The crossover Also, it occurred at this level right there. That's the exact moment. And so if we put a vertical line at each of these crossover moments, and you have to be real honest with yourself about when these occur, because the crossover technically often doesn't happen until it's actually like the moment after the crossover. That's where the candle closes, and that's where the crossover becomes permanent. So I'm going to put these lines at the exact moments where the crossover becomes permanent. And this illustrates kind of a little bit of the lagging nature of most technical indicators and why they are good, but also, kind of have to be taken with a little bit of a grain of salt. All right. So as we look at these different crossover points, let's zoom in a little bit. Even during this little uptrend here, you can see, let me bring an arrow, let me point to this. At this crossover here, technically that is a cross down, where the green line crosses down through the red dashed line. And you can see up on the price itself what has occurred at that moment. So when this red candle closed down, that's where we got the crossover of the MACD. And it's right at the base of this little downward move. And then did it ever go down after that? No, it immediately goes right back up. So this is why identifying price action, breakout, and retest is first and foremost far more important than crossovers that you experience on technical indicators, because these crossover points are lagging, right? We finally get a crossover back up. Where does it occur? At the close of this green candle. So at first, when we first glance at this crossover up, and let me give you an arrow, they said this is the line we're talking about right now. At that crossover up, it actually is permanent, you could say, at the top of this tall green candle. So in other words, the move has already taken place. This upward move that just occurred already took place when this crossover finally showed up. This is important because as you're looking at any indicator that has a crossover in its nature, more often than not, these crossovers occur after part of the move has already occurred. If you're in a real strong uptrend or a new trend, they work beautifully. For example, just to show you a couple of examples here, this crossover at that point, right, has this move. Let's go right to it, basically right there. And you can see there was some nice upward movement after this initial green arrow and this crossover right here, okay? But most of these other times, especially during any kind of time of consolidation, is you're going to lose trade after trade after trade, right? This one here, I'll put an arrow on it. So if we're looking at this crossover, I'll put a red arrow on that. Technically, that would be an indication for a sell, and this is commonly taught out in the trading community. And what I'm trying to illustrate to you is that this is a general flaw in how certain indicators are taught. And so we're not only going to show you kind of how they don't work, but also how they do work and how we can use them to look for potential trade opportunities. And so at this moment, you can see the downward move has already taken place. It's come down. We finally get the crossover on the MACD, and it was right at the base of this red candle, and price literally went up ever since. Okay, so terrible signal for a sell or for a put option at that moment. So we can't always use either a MACD or stochastics crossover or even an RSI just automatically because the lines cross over. At a very high level, surface level, it looks like they coincide nicely with trend change direction, but they're not necessarily very good at specific timing of entries, okay? So the next question then is, well, then how do we use them, okay? And this is where other patterns and key levels, like we teach with the RSI of the 40 and 60 and the 50% as well, become very important as we look for anomalies. For example, right here, as price was going in the upward direction, price is climbing. I'm going to summarize a couple of these little, there we go. And price comes up to this level, all right? Now, when price had come back to this level, price got rejected and it came back to this level. The MACD, similar to the RSI, we showed this yesterday with divergence. What do we see in the MACD? Well, as a measure of momentum, we can see, let me grab my line tool here, we can see that the overall positioning between these 2 points is divergent. We have a relatively flat and even a slight increase of price at this level. Price goes up even slightly, but yet the MACD is going down. You can also see this on the histogram bars, maybe a little bit more clearly to some people's eyes. So if we compare those same points in time, ultimately we're seeing there's a significant decline in that momentum versus the rise in price here. So that's our divergence, and so we could look for a potential put option even though the overall uptrend is in the upward direction. Those are early indications of a trend reversal, or if the trend is basically going to move in consolidation, which is pretty much exactly what it did. It started moving sideways ever since that time. And so the point is that we begin to use technical indicators in a slightly different way than most people teach. We're not entering at these crossover points. If you're going to use these crossovers, generally speaking, the way you want to use them is to give you the general trend direction, especially on longer trends, which you can't always predict in advance. But for example, at this crossover here, we can see price move generally up. So when you see these 2 lines apart, that can be a little bit of an indication that that price is overall moving in an upward direction. Okay, so you can use it a little bit in that sense, but we're not using this kind of crossover as our specific entry reason, because we're going to get a lot of false signals, especially if the market's flat. If you look at this crossover here, which would be a buy signal, if you look at this crossover here, which would occur at about that level, this one would actually be all the way over here. You can see that at those levels here, we'll put a couple vertical lines. You can see these are really not that great of signals, okay? This one, at the close of this candle, it really doesn't even go up beyond that level until way over here, okay? So it's not a very good signal. This one here, it would be referring to a put option or a sell in the open market, and it went down a little bit, but just not much. So these are, during consolidation phases, these crossovers will give you a lot of false signals, or signals that ultimately wouldn't win. That's essentially what we mean by a false signal. In strong trending times, if price is really waving up and down, there's good volume, good volatility, then these crossovers actually can be quite useful, and they can give you an indication for a decent amount of price movement. But you have to have that volume and the volatility meaning the big up and down waves, in order for them to be reliable. So if by not using the crossovers as our point of entry, we can, in contrast, look at specific signs such as divergence to identify those potential trade opportunities. So one specific strategy here, for example, we see that we have some divergence. So at that point, we could determine, all right, what is our trade entry reason? I'll give you a couple of examples. One could be a confirmation candle. So as price comes up here, hits this level, we see the divergence occur. We don't yet have a cross down, right? Because the cross down, if we put our line here, it actually doesn't happen until all the way over here after this move has already taken place. So the price behavior, the price action is a far better signal. And so price action would suggest that this candle here, as well as this candle here, would actually be better confirmation candles with that divergence formation, suggesting that price is then going to turn around and go in the downward direction. It would be still a bit of a questionable trade because we are in such a nice uptrend. But again, if you are looking for divergence, divergence is a trend reversal pattern. And so we can use that, suggesting that, hey, maybe this trend is petering out and we're no longer have this same strength that we did at the beginning. And so we could consider a reversal trade opportunity at that point. And so both of those trades would have won utilizing our 3-candle rule. And the first one might have, taken, it looks like it would be really, really close. It's like right at that level. So that the first one might be questionable. Second one definitely would have won. But that's the basic principle, okay, of how you can utilize a technical indicator in the correct way to give you the actual entry timing and not to rely on these crossovers that occur. I've done literally thousands of hours of tests on many technical indicators looking at these specific crossover points, not just on the MACD, but on the stochastics, on the RSI, on Ichimoku Cloud. I mean, you name it, I've looked at it. And And with each of them, that has a bit of this lagging nature to where you finally get the crossover after the move has already taken place. That's highly problematic. Even for us in HFX, when we don't need price to move in our direction for very long, it still doesn't give us a very good trade entry timing, right? That moment where we want to get on the bus. So keep that in mind as you're looking at any technical indicator of knowing how to use it properly. It's not that they work or don't work. It's that you either know how to use them correctly or you don't, right? And so that's the purpose of our training sessions, is to teach you how to use them correctly. So let's apply these principles directly into Hourglass as well as Go Liberty. Now in Cash Trap, which is in the Hourglass website, we have two different strategies, the Blue Gator and Cash Trap. Each of these have different technical indicators that can help us to identify potential trade opportunities. Now, when we're in Cash Trap, which is one of the more commonly used strategies, and as Brandon mentioned, they're coming out with Cash Trap 2.0, which will be even better later on this week, hopefully this week, and if not, it might be early next week or whatnot. With programming, there's always a little bit of ifs, right? But ultimately, we're looking for price action patterning combined with some technical indicator confirmation. So, for example, here we're on USD CAD. We're looking at price. We're saying, what is price telling us? Well, at different times at a very basic level, we can look at the middle moving average line as kind of a starting point indication for what price is doing. What, in other words, what is the trend direction? And maybe we'll change this color to blue if that's a little bit easier to see. Actually, I think red might be better. But basically, as price is above here, we can be considering call options. And then when price is below that level, okay, below the middle moving average lines, we can be looking for put options during this time. And we'll talk later this week about our specific trade entry reasons and how we would take those. But ultimately, again, your starting point for your trade decisions is to identify price direction, right? And that may feel like, well, duh, Josh, of course we need to know price direction. But if we don't know how to identify whether we're in consolidation or in a trending time, it makes it very difficult to identify the price direction, okay? So utilizing some of these technical indicators can be a good starting point because anybody can see, hey, price is above moving average line. And you can also look at price action, say, hey, we just broke above a previous pivot point. Here's another nice breakout, retest, breakout, retest. I mean, does this over and over again. We can look for all manner of call option opportunities. Same thing here. Price pushes below the middle moving average line. That's a breakout, retest, breakout, retest, breakout, retest. So we can look for that patterning over and over again for as long as the trend continues. How do we know when the trend is ending? Simply look for these times where price crosses over the middle moving average line. You see it here, you see it here. So the moment price crosses up and is hanging out above this middle moving average line, I'm no longer in this previous downtrend. The moment price crosses down through the middle moving average line here, that means I'm no longer in our previous uptrend. Okay, so by starting out, by simply identifying, are we in a trending time and which direction is that, that gives us a little bit of a positive bias on our trades to where we can say, you know what, I'm looking for call options only, or I'm looking for put options only, because price is primarily moving in this direction, right? And so that's important because if you happen to need a little bit more time in the trade, chances are that the price ultimately will go in your favor if you have identified the primary trend correctly, okay? And so, and in this case, we would be looking for down arrows. I wouldn't take this because I need to refresh my chart, but ultimately we're looking for down arrows when we are in a downtrend. Price has been staying below this middle moving average line. We're seeing some nice breakouts. We're maybe looking for a retest here. So we can be looking for down arrows in this downtrend on the USD to Canadian dollar. So that's how we would go about utilizing even just the middle moving average line, which in this case is a 20-point moving average line. You can also see that it is below the purple line. It's kind of a little bit busy in there. You can kind of see the purple line inside of there. That is the 200-point moving average line, which is telling us the overall trend. At the present time on USD CAD, it is below. In other words, price is below the 200-point moving average line, suggesting that we are in a downtrend. We are also underneath the 20-point moving average line, which is suggesting that we are also in a downtrend. So we could be looking for put options during that time. So you can see how we look at price behavior, such as breakout and retest during trending times, combine that with a couple of technical indicators, things like the moving average lines, to further confirm that we are in fact in that trend. Now, so the next question then becomes, how do we then utilize the stochastics, which is this top indicator here, and the RSI, which is this bottom indicator here? Now, you know from if you've been a part of our previous training that we utilize the RSI in a very specific way with the settings of 60 and 40. Now, the RSI in Hourglass as well as on Go Liberty is utilized in a little bit more of the traditional overbought, oversold type of teaching. Now, there is a time where that seems to work, and that is during trending times. And so let me show you exactly how that would work. So here we are in a downtrend situation on USD CAD. So as price kind of breaks out to the downside, comes back up to retest, what we're looking for, a useful kind of additional confirmation, would be this moment here. Let me grab a couple of arrows. We could be considering times where you see it come into this upper range, which traditionally they refer to that as overbought, right? But ultimately, once you get the cross down, all right, which would occur if I was putting it, let me see if this will give me a vertical line there. It did, it's just not very thick. Let me adjust that real quick here so you guys can actually see that line. All right, that is where the crossover takes place. So you can see that as we identify a breakout to the downside, a retest moment, overbought conditions, and then the crossover. See how the crossover now lines up perfectly with the downward move. So if we look for a red arrow at that same time, and even if you don't, there's some good reason to take that trade. But ultimately, that's where the cross down of the plot line down through the top dash line can be a good confirmation of a trend continuation move. But it's important to note that I'm not in a downtrend. I'm not going to take any of these cross ups of these bottom where the black line is down below the green dash line. I'm not going to take any of those oversold signals because I'm in a downtrend. So I'm only looking for put options. So I want to look for times where I see, okay, things are overbought, you could say, and I'm looking for the cross down to indicate that price is moving back in the downward direction. All right. Now, keep in mind they are at times a little bit lagging, so you have to be a little bit careful of that. Sometimes you want to preempt it, but that's why I like to use price action and candlestick patterns as my primary reason of entry. But you'll also get those same signals with these arrows in Cash Trap. If you're looking at Go Liberty, you're going to get a lot of the same signals, not so much with arrows, but in the overall breakout or retest structure, looking at the 200-point moving average line versus the 20, and you can look for similar trade opportunity signals. So take-home message for today with regards to technical indicators. Recognize that they are useful and that they, if used correctly, they can be phenomenal at confirming the information that you're already seeing through price action alone. Price action is simply the breakout, retest, or what these pivot points are doing. If we're not experiencing breakouts, like as in this situation here, this pushed up slightly, but this is not a confirmed breakout because we didn't get a nice arch formation up above. And so for now, we could say we're in consolidation until we see a consistent breakout in one direction or the other. And the relative top and bottom, excuse me, would be looking like this. And as our consolidation zone continues, we don't want to keep these lines in the same location. We actually want to move them progressively to whatever the most recent top and bottom pivot point are. And that is going to give us the earliest indication for where price is going to move next. And we finally see that here. Price came to this pivot point and pushed down, finally broke up to the upside, came down, retest this previous pivot point, not this one, okay, not this one. Price doesn't care about these anymore. It's responding to the most recent top pivot point. Okay, once we pass and once we form new pivots in the market, those are the relevant pivots. We no longer are considering all these ones from the past. And that goes for all future price activity as well. So for right now, we're looking at, for example, I'll just draw this real quick and then we'll wrap this up. So right now we have a pivot point here, okay, and a pivot point here, okay? And then it's starting to form a new top pivot right there. So we could look at price Is it going to respond? Is it going to break out above this one, or is it going to break down below this one? All right. So as you compare price to what it's going to do next in relation to each of those, that gives you the most recent relevant information as far as the next opportunity. Now, we could use the MACD here. You can see we have a cross up here. So we're not using this as an entry reason, but we can say, hey, we're generally in an uptrend. So if we were to get a breakout to the upside and a retest, combine that with the fact that the MACD is suggesting that we're in an uptrend, now the MACD is useful to us. It's not giving us the specific entry timing, but it is saying, it is suggesting that, hey, we're in an uptrend movement. But we combine that with a big if price breaks above and comes down, retest gives us a confirmation candle, we could consider a trend continuation move in the upward direction. So we become very rules-based about our overall approach and make sure that our decisions are based upon data and that we're not trying to prophesy the future. We're not trying to say, I think price is going to go up at this point. Well, we don't know that yet. Until price is broken above this pivot point, we do not know if price is going to push up or not. Once it shows us it goes up, then we can reliably say, if we get a confirmation candle down here, there's a high probability that it will continue to go in the upward direction. That's how we play the trading game, and that's how we consistently have those high win rates that you see on the flyers on a consistent basis. So with that, we appreciate you guys being with us. Hopefully that's helpful and provided some clarity with regards to technical indicators and how they're useful, and also kind of where they tend to break down. And but keep practicing. We'll cover this in more detail and talk about other indicators as well as the week progresses, as well as trade entry reasons. And so we look forward to our future sessions with you. With that, Brandon, I'll turn the time back over to you.
Awesome, well, guys. Hopefully you got some tremendous value out of that. We are super grateful that you've had the opportunity to be on. I've actually had people sending over the information for the flyers during the session for a minimum of 50 trades. So I want to give a shout out to you guys. We're going to post your flyers on Friday. So be gathering those results, series of 50 trades, high win rate of at least over 70%. And then we'll choose those 3 top performers of the week. We're super proud of you guys. You are mastering the skill. You're learning how to do this. Not only just getting on Go Live sessions and taking quote signals, right? Which of course are called market ideas, but you're actually learning how to trade. And we're receiving the proof. So we're super proud of you guys. The call is being recorded. We will send it out through Telegram and Facebook, and make sure you guys can watch it again and share it with others so that they log in and go live to all the active HFX members. Guys, have a fantastic Wednesday. We appreciate you. We'll get the music going here. We'll see you guys at the top. Thanks, everyone.
This is what it feels This is what it feels like.